EPS, their earnings per share, so that's their net income received by every single shareholder for each stock they hold, is going to increase by 26% year over year. That's pretty strong performance. As you can see here, we say that's much stronger than their peers, and they tend to beat the expectations. So all in all, it looks pretty good for Magni. Now, effectively, this has already been priced in. You can see in the bottom right here, the red line shows their earnings for 2013 has increased from 8 rubles a share, $8 a share, I should say, all the way up to $11 per share across the time that people have been predicting. That's pretty strong, as generally speaking, sell-side analysts start really, really high. They say, yeah, this company is going to have amazing growth, and then it's going to slowly come back down as people start to realize the reality of the situation. Okay, so it goes all the way up, and it tends to, that's a really positive sign, and that's really been priced in already. Now, how does that fit in with dividends? If I click on current consensus, you'll see that we also have forecasts here for dividend per share. So you can see dividend per share is actually really very strong growth expected. So they're almost going to double their dividends in 2 years, which is not a regular stage of growth by any means. Okay? If you're experiencing that sort of growth, it can be quite difficult to value a company based on a dividend discount rate. Okay? These sorts of factors will have a very big impact. Okay? So here you can see where the data is coming from as well. So assuming that we don't necessarily want to use DVM to work this out, we'll still take a look at where the data comes from. If I click on that, it should show me the data. There we go. It's just being a bit slow. You'll see these are all of the people that are making projections on what Magni is going to be doing. And you've got quite a big range of that. So you've got some people who say their dividend per share is going to decrease by $2 a share. Some people who say it's going to go up to almost $6 per share. So there's very, very big deviation between all of those analysts providing the data. So you might want to consider that with with a pinch of salt. So here, Morgan Stanley, very, very bullish. And here, Sberbank, not quite so bullish. In fact, very bearish. Okay? So these are their figures that are being put into those calculations and driving that range. What else goes into the calculation? So we have to then work out, okay, we know we have these cash flows coming in, and they may be good or they may be bad depending on who you have analyzing your stock. But then we have to discount it. How do we discount it? Well, we work out the risk premium to get to the risk premium for the stock, effectively. Okay? And that will give us all of the components that we can come in to produce our end result. What goes into this? Well, you can see it on the right-hand side. You've got the bond rate. This is the 10-year government bond for the country that you're looking at. That's your risk-free rate. In the old days, it was called risk-free rate. Whether or not you can call it risk-free anymore is very difficult to say, but that's what you would expect to be getting at any point. So you should be able to get 4.6% without having to worry too much. Then there's another element to it, and that's the country premium. The country premium here is the premium that you pay for investing in Russia. Okay? This will be sensitive depending on country to country. You would expect to get 7.3% for investing in Russia. Okay? Now, not every single company is going to exhibit that exact same level of risk. So, for example, if we take the UK as let's take the US as an example here, just for kind of a major market with very clear kind of mature level and growth level companies. Where do you think is going to be more risky? Putting your money with IBM or putting your money with Twitter or Facebook? Right? That sort of idea of risk and sensitivity comes in. One of them is going to be much more sensitive and much more reflective of volatility in the market than the other. And that's why we have beta there. So beta here will tell you how sensitive your company is to movements in the market. Bloomberg will calculate a default beta of 2-year based on 2-year weekly data. And here it says that Magnit is relatively insensitive, which is good. It suggests that it's quite a strong, mature company, if you will, or in this case, really non-cyclical company. So you can see that for every 1% that the index moves up, Magnit moves up 0.76%. Likewise, for every 1% it moves down, it only moves down 0.76%. Okay? So you can think of it as being a less volatile stock. For that reason, you don't need as much risk premium to really justify what your investment. Okay? So we times one by the other to get a risk premium of 5.57%. This is essentially your expected return. So this will be how we discount. This will be the rate that we use to discount any of these different dividends or future payments, because it's what we're expecting to be paid at each particular juncture in the future. Okay? Everyone happy with that? All those pieces kind of fit together nice and easily? Yeah? Any questions? No? Okay, cool. So, that's really probably all the time I should spend on this screen, because it's not a very exciting screen, as I'm sure you can all agree. And we'll see something a little bit more interesting that will let you do more in-depth analysis. So, dividend discount model is a basic type of discounted cash flow model. We've seen some of the weaknesses. It doesn't work for companies that pay dividends. It doesn't work for companies that are in varying stages of growth, and it can be quite sensitive to a lot of changes. For that reason, people will often use free cash flow as a more stable sense of earnings. It's still difficult in the growth stage of a company to be able to use free cash flow models to get an accurate value. However, we can go in with a better knowledge than if we don't know that they're paying, or we know that they're paying no dividends at all. So what data do we need to use for that? Well, we need to use real fundamentals and then some type of forecasted value for the cash flows. Okay? So I'm going to show you now where we can see those figures. Okay? The easiest thing to do, and if I do Magnit again, I'll just type it in, select it from the list, and come into financial analysis. FA here is the home of all the fundamental data. Zoom in a little bit because I can't really see it. Cool. So this is where we store all of the fundamental data that is relevant for single securities. We have some highlight tabs here because in general, whilst lots of people will go through this process of valuing a company in a big model, once you've done that once, you don't need to do it lots of times again because their growth rates and things like that won't change on that frequent a basis, and you'll probably just try and make determinations based on some of the margins and growth rates. Okay? So you can see here, we've got a view of most of the key points of the company. We can see about the capital structure up here at the top. So I can tell that here, Magnit doesn't have a massive amount of debt. It's fairly small proportion relative to the overall capitalization of the company. So that's what, like 5% or something, okay? Not a massive amount. That means that you probably wouldn't look at free cash flow to the firm model. You could technically do it because they have some debt and there are bondholders who need to be paid, but it's not enough to necessarily justify it. Anyway, that tells us a little bit about the capital structure. If we look down, we see these next items. These are all the income statement data points, and these are decided because they'll give you the headlines as you move down the statement. You want to know how much is coming in at the top. Is that growing or is that shrinking? If you have less coming in, then you'll probably, well, all else being equal, you're going to have less coming out at the bottom. So you want that number to be continuously growing. Here you can see that it's grown. It's not quite exponential, but it's not exponential in the slightest, but it's still very large numbers. Okay? We can plot this nice and easily just by clicking there, and you'll see that's a nice straight line. This is the perfect line for anyone initiating coverage on a new stock. It looks very good in all of your reports. Okay? Now you can see that for the growth is there for revenue and for the bottom line, so for your EPS. And you'll see here that they really show a similar sort of pattern. Generally speaking, the EPS will tell you how they're doing, are they becoming more or less efficient. So you can see that their bottom line growth in 2012 was substantially better than their top line growth. So this grew, top line grew 26%, whereas the bottom line almost doubled. In the future, we expect to see similar levels, which means they're being just as efficient going forward. The other things we have on there are margins. The margins are going to tell you about efficiency at various stages in the company's course of business. So for the gross profit, you're looking at whether or not they're being efficient in raw materials sourcing, perhaps getting cheaper supply chain. After EBITDA, you've got incorporated things like sales and advertising and things of that nature. And then net income will tell you really at the end of the day, have they got non-operating items that are causing them to lose money, things like that. Okay? So it's giving you a good view of the whole set of information. These estimates come from exactly the same place, so sell-side analysts will be forecasting this data. I will put them side by side so you can see what's going on. Now finally, we'll also generate here